嗯？啊？为什么？Hello, hello. Hello, good morning, everyone. Can you hear me? All right? Okay, brilliant. So let's just wait a moment. Um, just having a quick chat while we wait for everyone to jump on. Okay, everything seems to be working fine on the stream, so yes, let's get started. Today we are focusing on the AI value chain. I'm not sure if any of you are already training AI related stocks or safety products, but today's content is quite practical. We will do a comprehensive breakdown, especially on how you can use Ultima markets to trade US stocks or build an AI-focused investment portfolio. So before we dive in, let's go. Sorry. Uh, Let's go over a quick risk warning. The products we discuss on Ultima Markets on CFDs, which are leverage contracts. So because of the leverage, losses can exceed your initial deposit. So please make sure you manage your risk carefully based on your own situation, capital, and risk appetite. Right, let's get straight into it. We have a lot of ground to cover today across four main dimensions. From the rise of AI last year to semiconductor infrastructure this year, the trend is very clear. A lot of assets have already had massive runs, so the big question is, can they keep going? To answer that, we need to look at the macro picture to the core fundamentals. Today, I will show which sectors you should watch if you are looking at AI stocks and how to build your investment strategy on Ultima Markets MT5 platform. First of all, of course, is the NVIDIA. As the powerhouse of the GPU and AI era, NVIDIA's rally since last year it has been very remarkable. You can see that, see the picture, pushing its market cap past 3 trillion, and then 4 trillion, and even $5 trillion. Even with occasionally pullbacks like when we see terrified discussions from Trump the last year, 2025, but even now in June 2026, NVIDIA is still incredibly strong. That said, it's not quite the solo leader it once was, as we are starting to see capital rotate into other areas. You can see this picture. After such a massive run, some money is naturally moving to other sectors. As I mentioned at the start, if large language models were the main theme of 2025, 2026 is much more about the entire infrastructure stack, AI servers, AI computing power, and so on. This chart shows NVIDIA's daily price action loaded on Ultima Markets MT5, and if you used NVIDIA graphics cards back in the day, whether it was the 28, 1070, or earlier models like the 908 or 78, you will remember how popular they became during the crypto mining boom. But AI is different. Modern AI relies heavily on neural networks. It processes tokens, words, or pieces of text and looks for connections between them. Traditional CPUs couldn't handle this kind of processing because it requires immense parallel computing power. So you can see the chart, even with NVIDIA rising about 173% since April last year, its performance has actually lagged slightly behind the broader semiconductor index. You can see these two charts. Why is that? You know the reason? Because the semiconductor index isn't just about GPUs now. It also includes standard CPUs and memory chips, which we have seen massive demand since March this year. These chips required advanced technology, and the entire memory sector has done incredibly well recently. So this shows that the capital is no longer just chasing NVIDIA. Investors are looking across the entire value chain for companies that still have room to grow or offer compelling revenue prospects. That's why the broader semiconductor index has rallied so strongly, largely driven by memory chips, which we will cover in the moment. Essentially, the market has shifted from a single stock narrative to a broader industry-wide expansion, bringing names like AMD or Broadcom, Intel, and Amazon. When we look at AMD and Intel, they are primarily CPU manufacturers. As I mentioned, the GPU era is about running large models, AI models, and token search. But AI is moving into a new phase where we are seeing a shift towards CPUs. Because AI agents, whether it's automated coding assistants or personal agents, the focus in 2026 has shifted from a simple chat box to AI systems that can actually do the work for you. And last year, you might have asked an AI to write a short text or answer a quick question. But in 2026, if an AI only answers questions, it's not enough. We want to give it a task and let it run with it. For example, if you want to compile a report on AI industry, in the past you had to prompt the AI, verify the facts, and organize the sources and rewrite it by yourself. So it didn't save as much time as you would hope. But in 2026, we are in the era of AI agents. Think of it like Tony Stark's Javas. You want an assistant on your computer that you can assign tasks to and just gets them done. This is where CPUs become critical. Running these agents and opening various software applications places a heavy load on the CPU. If the CPU isn't powerful enough, the agents won't run smoothly. So CPUs are beneficially strong and are benefiting a lot in this agent era. If you look at AMD and Intel, their rallies this year, you can see a credible keeping pace with NVIDIA's strong movement. And this is the TSM. We will talk it later. Broadcom and Amazon are slightly different. Broadcom and Amazon. They are trying to lower their cost by developing their own custom chips because NVIDIA has dominated the GPU space for so long, and the other tech giants can't easily copy their general purpose chips. So instead, Broadcom, Amazon, they design custom ASICs, often called TPUs. They are tailored for specific tasks like querying a company's internal databases. This approach is much more cost-effective. While they are not as versatile as NVIDIA's GPUs, they don't require the $1 million price tag of high-end GPU server racks. This is why Broadcom and Amazon have been strong rallies in this cycle. So far, we've talked about CPUs, GPUs, and standard computer processors. The next key component in this agent area is the memory and storage. Why is memory so important? Because you want an AI to perform complex tasks. It needs to remember what it's doing, Otherwise, it might lose the context of your conversation halfway through. To store both short-term and long-term context, you need a reliable memory. High bandwidth memory, or HBM, is the critical technology here, especially for data centers, because it offers incredibly fast speeds. When you ask an AI to do something, you don't want to wait several minutes for a response. Even a 2 minutes delay makes the system feel sluggish. I think everyone can have this same feelings like that. This speed requirement is why HBM is so important. It's so sought after in the AI era. The manufacturing and the packaging processes are entirely different from older memory technologies, which has driven massive gains for Samsung, SK Hynix, and Macron. So if you are looking at individual stocks, the memory sector is definitely worth watching. Though prices have already run up quite a bit, we are talking about specific strategies for this shortly. If we look at the manufacturing side, you can't build these chips without the right equipment and the supply chain. Last year, the logic was to invest in NVIDIA as the picks and the shovels providers, but in the agent area, if you want to avoid betting on a single stock, you can look at the companies that supply the manufacturers, like TSMC, like the Applied Materials, TSM. You can see the chart. TSMC company is in a league of its own. Their technology and manufacturing comparables are well ahead of the competitions. Interestingly, TSM management has been quite cautious about expanding capacity too quickly. While expanding rapidly might boost near-term revenues, building these advanced fabs takes 5 to 6 years. If the industry cycle turned down by then, they could be left with massive oversupply. So right now, TSM company capacity is completely booked out. Looking at the charts, you can see how far the stock has run above the 200-day moving average. But I didn't put the indicators on this chart. We can see later on the MT5 platform. The second key player is Applied Materials, which provides the etching and the inspection equipment. Without these machines, you simply can't manufacture memory chips, custom ASICs, or GPUs. Or we talked before, like these companies. Both TSM company and Applied Materials are classic picks and shovels players. So this is the TSM daily chart, and this is AMAT Applied Materials daily chart. You can both read these charts on our Ultima Markets MT5 platform. So you can see the this week we see a little bit short squeeze here, where the price breaks two new highs without pulling back, likely triggering stop losses for short sellers. With charts like the AMT like this, it's usually not ideal to chase the price on the breakout day. It's often better to wait for a pullback to key levels like Fibonacci retracement 38.2%. Of course, if you are looking at these from a long-term investment perspective, long-term you can scale in gradually. Just make sure you have solid risk management in place. Now let's move on to a theme that gained a lot of traction recently: liquid cooling, optical interconnect, and power. This isn't entirely new, because investment banks like Goldman Sachs and JP Morgan were writing about these concepts last year. But now we are seeing the entire value chain benefits. While some of the early runners are now quite expensive, there are still lagging stocks worth looking at, particularly in server infrastructure. So why is liquid cooling so important? Because this AI data center run 24 hours, and the heat generated by these chips is immense. The traditional air cooling system aren't always enough anymore. This is where liquid cooling companies come in. Then we have optical interconnects. In the past, copper cables are sufficient to connect GPUs, but AI chips use optical signals rather than electrical ones. To handle this, we need optical transceivers to convert electrical signals to light, which has sparked a lot of interest in optical connective. Another emerging technology is co-packaged optics. We also call CPO. Both optical interconnect and custom silicon packaging are major themes right now. While these stocks have already rallied, I don't think they are reached their peak yet. But because the actual earnings are only just starting to show, we are likely to see the trend continue well into 2027. In my humble opinion. Okay. The third major bottleneck is electricity. Is the electricity. Because without power, none of this works. You can have the best chips and servers in the world, but if you can't plug them in, they are useless. The power consumption of these modern data centers is extraordinary. Honestly, very few countries have the infrastructure ready to support this level of power demand over the next few years. In the US, much of the grid relies on older infrastructure, and the political debates between Democrats and Republicans make it slow to approve new power plants, whether they are gas, nuclear, or renewables. Getting approvals for data centers and power infrastructures takes a long time. So creating a major bottleneck for computing power. If you are not sure which utility stocks will benefit, you can look at the underlying commodities, copper and natural gas. At a recent conference, NVIDIA's Jason Huang highlighted the importance of copper and optical connections. JP Morgan also recently upgraded their copper price targets as a key material for electrical grids. Copper is highly likely to benefit from this infrastructure build, although it remains sensitive to broader economic supply and demand. Over the long term, the outlook for copper remains very positive. The second key commodity is natural gas. So why is natural gas? Because you need fuel to generate electricity. While coal is cheap and plentiful, it is highly polluting. So for developed nations like EU, US, natural gas provides a good balance between emission targets and power generation efficiency. So let's look at the copper chart first. You can see the daily chart shows some volatility, but the long-term trend remains intact. You can see the long-term. Uh, it has focused some pressure recently due to the tariff concerns in the U.S. But because of the deep liquidity in this market, it's usually better to build positions gradually on pullbacks rather than trading breaks out. This chart is about is on the yesterday. The rally isn't finished. It hasn't been finished. If you see the newest chart, sorry, let's open the MT5. MT5. So you can see the parallel line. Actually, yesterday it's pullbacks. Pullbacks about, let me see, about 3%. 3%. It's actually it's a quick. It's a really big pullback, and so we should emphasize more because of the deep liquidity in this market. It's usually better to build positions gradually on pullbacks, because the long term is very positive. But if you want to trade on daily chart, or maybe in 2 hours or 1 hour's chart, actually I think you should be patient. Okay, and the natural gas is this is natural gas. Natural gas is a bit different. Prices were depressed previously due to the shifting dynamics in Europe and situation in Ukraine. Historically, Europe relies heavily on Russian gas, but those volumes have been phased out. Natural gas is also highly seasonal. It tends to be more expensive in winter due to heating demand and cheaper in summer. So, however, we are already starting to see prices moving up. You can see this early rise. Natural gas is partly driven. You can see it's partly driven by the growing power demand from data centers. Looking at the daily chart, we can see a potential. This is the double bottom forming here. Sorry, the double bottom. Double button. Sorry, the double button forming here. If you prefer a move conservative entry, you might want to wait for a clean breakout above the 3.5 here, 3.52 level. But as an investor, you are always looking for value areas to build a position. It's different. It's different. So to summarize the value chain, we have the core chips, the semiconductor manufacturing equipment, the server components like liquid cooling, and the optical interconnects, and finally the power and the utility bottlenecks. On Ultima markets, you can access all these different segments. If you want to focus on the absolute core of the AI boom, you have NVIDIA, Amazon, Microsoft, and Google. These giants are the direct beneficiaries of both the LLM, the large language models, and the AI agent areas. You can see all these stocks on our Ultima Markets MT5. Among these, Google is practically interesting. I think it is heavily involved in AI infrastructure, and its Gemini model and integrated workspace agents are showing great promise. Unlike some tech companies that rely solely on issuing corporate bonds to fund their capital expenditure, Google recently raised around $8 billion through equity to fund its AI infrastructure. Berkshire Hathaway's Gray Abel has also shown interest in this space with substantial investment in Google. So if you are looking for exposure to major AI models, I think Google is definitely one to watch, and you can trade it directly on Ultima Markets MT5. So for the semiconductor supply chain, we have TSM and applied materials. If you prefer not to pick individual stocks, you can also look at broad market indices like S&P 500 and the Nasdaq 100. Here you can see here the tier 3. Since these major tech names make up a significant portion of the indices, you will still get a solid exposure to the AI theme. So at last, you can use commodities like copper and natural gas as a hedge against potential valuation bubbles in tech stocks. While the outlook is promising, we have to be realistic about the risks. The first major risk is capital expenditure. Many AI companies are borrowing heavily to fund their infrastructure. Previously, companies would issue debt to buy back shares and boost the shareholders' returns. Now they are spending massive amounts of cash on data centers. If it turns out the demand for AI agents and personal assistants isn't as high as expected, a lot of this capital expenditure could end up being wasted, similar to what we saw during the dot-com bubble in 2000. And the second is the everyone rushed to let's talk about the 2000 dot-com bubble. Back then, everyone rushed to build out fiber optical cables and internet infrastructure, but the demand wasn't there yet, leading to a major market correction. So watching corporate earnings and guidance is crucial. If we start seeing margins or revenue guidance slips, It could be an early warning sign. Additionally, the semiconductor index is currently in overbought territory. So if the Federal Reserve keeps interest rates higher for longer, it could put pressure on tech valuations and increase borrowing costs for those capital-intensive companies. While there is always talk about potential rate hikes if inflation ticks up, the economy currently remains resilient and enough to handle it. Another risk is the timeline for power infrastructure. Building out electrical grids takes years, and if power constraints limit data center growth, it could cap the revenue potential for the entire supply chain. And the last, there is always the risk of technology transitions, such as custom ASICs replacing GPUs faster than expected, through the immediate probability of the disrupting the major players remains relatively low. The main takeaway today is that we shouldn't just focus on NVIDIA. While NVIDIA is undoubtedly the leader of this AI era, you can see this chart. NVIDIA is undoubtedly the leader of this AI era. Its valuation is already incredibly high. As we look ahead to the second half of this year, major upcoming IPOs like SpaceX and the potential listing from companies like OpenAI and Anthropic could draw a lot of liquidity away from the current market leaders, potentially triggering a healthy correction. This is similar to what we saw with gold recently. Gold had a massive rally early in this year, pricing in a lot of macro uncertainty and concerns about US debt and inflation. Once those moves played out, capital started rotating into higher yielding assets like AI tech. As we head into the second half of this year, managing risk and keeping an eye on capital rotation will be the key. Okay, if you are looking to build your own portfolio or test your trading strategies, you may want to check out the Ultima Cup trading competition. This is our new competition here. Ultimate Trader Cup. Currently running on our website. It's a great way to put your ideas to the test over the next 50 old days with ranking based on percentage returns. So that's all. If you have any questions. So all right. Thank you all for joining me today. I hope you found the breakdown of the AI value chain and the portfolio strategy helpful, and have a great morning, and see you next day. Okay, bye bye.